Thanks for joining us for the Executive Series. Today I'm talking to Richard Murphy, who is the CEO of XTB. Richard, great to have you back.
Thanks, Tom.
Now, why don't we just quickly recap on precisely what XTBs are?
XTBs, if you've seen these series before, they are individual securities, each one tracking a different corporate bond, and there's now 39. We had 17 when I first spoke to you. There's now 39. So there's a BHP, there's a Telstra, there's a Woolworths, there's Lendlease, etc., etc. So when you buy one of those, you get the returns from that particular corporate bond, and it's pretty capital stable. Term deposit yields down here, they're kind of here, and equities and hybrids are up here, but they're more volatile. And that's really what XTBs are in a nutshell.
Of course, and when you're in a low interest rate environment, the way we are at present, the sort of returns that you get on corporate bonds are quite attractive. How are investors responding to this sort of product?
Well, obviously, lower for longer is the environment we're in at the moment, with another rate cut to an all-time lows, you've just indicated. And what we're hearing on a regular basis is, well, notwithstanding that, I'm still leaving a lot of my money in the bank. So if you look at the APRA stats, 778 billion was the latest stat from the RBA and APRA about term deposits and household deposits in bank accounts. That's up tenfold in what it was pre-GFC. And if you look at a subset of that, the cash component of self-managed super funds, that's still sitting at $160 billion. So people, notwithstanding the very low rates, they're not rushing out and investing in property or equities per se. They're leaving a lot of their money in cash. So really what they're saying is, can you give me something that where it's maybe a bit of a better yield than a term deposit, doesn't have the volatility of equities and hybrids, but what's in the middle between equities and hybrids and term deposits? I'll leave some money in the bank, but I'd like something else that gives me a better yield. And so corporate bonds, XTBs on corporate bonds, can give you 1% or 1.5% greater yield than a term deposit. It's more risky, but it's not as volatile as equities and hybrids, which for your growth part of your portfolio, so it's still in the fixed income part, and you're getting maybe 1% or 1.5%. So if you're getting 2.5% from term deposit, you go to 4% from an XTB or bond, that's suddenly a 60% uplift in your return. And if you're a retiree, that makes quite a difference.
Okay, why don't we just quickly focus on some of the risks, because obviously in a low interest rate environment with the prospect of rates going lower, it's a vastly different story to the potential of rates going up.
Indeed, and if we just ignore rates going up, because nobody really thinks that's likely, rates going down, fixed coupon bonds will go up again in value. And if rates go up, they'll go down in value. So that's probably the expectation of most people, that rates are going to go down again sometime in the next 6 months, and therefore those bonds are going to rise in value again. So people are actually buying them now, thinking, well, they'll rise in value in the short term.
Let's talk about the frequency of payments. So generally they're annual or semi-annual payments. If you're an investor that's looking for monthly payments,
yes.
How are these needs met?
We do hear that quite a lot from particularly retiree and close to retirement phase, where people are looking more for income. And most corporate bonds are paid 6 monthly. The floating rate ones are paid quarterly. And I think we've got a chart that shows that if you go to your CommSec account and you looked at the floating rate bonds that pay quarterly, if you stagger the payments, you can actually get payments every month. So you actually buy 3 staggered floating rate XTBs, and they will give you payments every month. So we have an example that in a chart showing you 3 payments, and then therefore you get monthly payments every month. So that's an alternative to your 3-month term deposit, where you might get maybe 2%, and you can get about 3%. So that's again like a 33% uplift in your income if you're a retiree. So that's something that people are starting to look at now, because it obviously gives them greater yield without going to equities and hybrids, which are a lot more volatile. So if you looked at the long-term capital performance of those floating rate XTBs, it's actually very, very stable. They're actually extremely low volatility.
So at the moment, XTB is being considered as an alternative to traditional term deposits?
I think alternative, but not the same, because a bank account is a bank account. It has a government guarantee. You can connect your electricity bill to a cash management trust, etc. Whereas XTBs and any security is security traded on the exchange. But because of the comparative lack of volatility compared with equities and hybrids, people are seeing it as, well, it's more risk than a bank account, because I'm lending money to Woolworths instead of lending money to a bank. And it does have, it's not like $100 in the bank is $100 in the bank. It's no volatility. There is, for floating rates, for example, 0.2% volatility. But that's a reasonable comparison to say, well, it is different, a little bit more risk, but I get more return. I get quite a significant more return from the security that I can buy via my CommSec account, and I don't need to roll over 3 months TD. Every 3 months I can be in this for 2 years, and that sort of ease of process as well, for the extra yield of maybe 30% uplift in what you're getting.
Richard, great insights. Thanks for your time.
Thanks, Tom.
And thanks for joining us for the Executive Series.